Today we'll talk about sources of financial capital. And this is an area that a lot of entrepreneurs spend a lot of time lamenting about, of where am I going to find money to start my venture. But I would argue that it's probably less intimidating and less difficult than you think. What I often find too is the belief that entrepreneurs are rich before they get started. And at least within individuals that I know, it's not the rich people that start companies. The rich people often have the opportunity and the means to do the things that they want to do and have the experiences they want to have. It tends to be the individuals that have not yet reached that financial success that want to start companies, and that one of their central aims of starting a company is to reach some level of financial independence. So if you're in a scenario where you don't have the funding to execute on your idea, I would say that's the norm. And so today we're going to talk about what are some sources of capital and what can you do to find the money to get your venture started. A central piece to understand too is, where does the startup money come from? Particularly in the US and to some extent in Europe, there's a lot of attention on venture capital. And let me go to a professional investor and raise money from them to launch my venture. In practice, that's only a small percentage of funding that goes into startups. Those types of funding are typically geared towards the highest growth, typically very high-tech ventures that are pursuing billion-dollar opportunities, and that's not the majority of new ventures. What instead we see is that for many entrepreneurs, they are using some of their own personal savings to get the ball rolling with their venture. And what we mean by that is not that they have substantial money to get moving with, but typically before a bank may lend you money, or before you're able to get money from a friend or family, they may ask you, well, how much money are you putting in? And it might only be a few $100s, it might only be a few $1,000s. So again, it might be relatively small when you look at the landscape of how much money do I need ongoing for my venture, but it shows commitment, it shows purpose, and it shows that you believe in the concept enough for you to put some of your money in, and thereby it's easier to raise money from others. So that way when we look at this chart, we see that of all the ventures that get started, more than half of them are having some personal money from the founders in to get the ball moving. From there we see friends and family come along as well and invest. And they do that often out of the relationships they have. Hopefully you have friends and family that trust you, that believe in you, and in that way you can find some of them that might have some money, maybe not a lot of money, but some money, and maybe it's an investment, maybe it's a loan, to help get the business moving and up and off the ground. From there we begin to see it transfers into partners and other sources of capital. We'll talk about different types of capital as well, both on the equity and the debt side, but this gives you some landscape that it's not the venture capital money that really drives the majority of new venture creation. It's a little bit of money from the founders. It's a little bit of the money from family. It's a little bit of money from friends, and that begins to be the foundation for where startup money comes from. There are often constraints in that, but let's think about the benefits. What can you do if you self-fund your company? You take no loans, you take no investment, you and your team, your other co-founders, you find a way to grow the company with only the money that you have in your pocket now. What are the benefits of that?
You generally get to keep all the money.
You own all the profit. There's no profit sharing with any other investors. There's no paying back bank loans. You keep all the profit. What are other advantages?
You're your own boss.
You are your own boss. We think that if we start a company that we're our own boss. Well, if you're borrowing money from the bank, they're your boss. If you're borrowing money or getting money from investors, they're your boss. So in that way, you might have just traded the types of bosses that you have. If you're leaving a job to start a company, if you need lots of loans and lots of investors to make it happen, you've just traded bosses. But if you can start it on your own financially, your customers may be your boss in some way, but you don't have investors or banks that you have to be accountable to. What else can you do when you're your own boss in that way? Yep.
Pay yourself what you want.
You essentially do what you want. You essentially decide. I like this market. I'm going to go after it. I think there's an opportunity for this product. I'm going to do it. I want to partner with this firm. I want to enter this geographic region. You don't have to justify or get buy-in from other investors to do those types of things. So lots of advantages. You own it. You control it. Whatever pressure you have, you put on yourself. It's not investors. You don't spend a lot of time going out trying to raise money. So why do people not always fund their own venture if there are all of these advantages to it?
Because they're risking their own money.
Okay, you're risking all of your own money, so if we want all the profit, we have all the risk.
You might not have enough.
You might not have it. You might not have the money. So you've got a great opportunity, but the window of opportunity closes. Competitors beat you to market because you were trying to get there with inadequate capital. You also may lose some of that advice, some of that know-how, some of that mentoring, some of the relationships that your investors or banks may have. So you give up some things if you are trying to do it solo. And you have to find the right balance of what makes sense. Typically, many firms do some of both. They put in some of their own money so that they share in the profit and the control, but they might seek some outside capital as well to not fall to some of these disadvantages. The landscape is big. There are lots of places to get money from. Each of these little dots are a source of capital. And there are many. There are lots of venture capitalists. All of these are venture capital firms in the U.S. There are lots of second stage firms that help you once you're kind of beyond VC. There are early stage VC firms. There are people that will lend startups money. I'm going to focus initially on these two groups. And what we see of those two are the crowdfunding sites, and we'll talk about a few of those. And there are also a lot of incubators that are out there that do a variant of funding and services as well. There's no shortage of money in the market for good ideas and teams that are credible. The lack of money should not be a reason not to start a company. But the type of money depends on what you're going to do. How much do you need? How much do you need? If I go to a crowdfunding website and I'm trying to raise $10 here and $25 there, and I need $20 million, probably never going to happen. If I go to a large venture capital firm because I want to raise $1,000, just not worth their time. They're going to spend more time in paperwork than the amount of money that they would make on the return of a $1,000 investment. So how much you need makes a big difference in where you could get it from. There's also the question of what you're going to use it for. Banks are skittish of loaning you money to do marketing. What happens if your marketing campaign doesn't work? You don't generate the income that you need to pay back the loan. Can you take the printed ad that you had in the newspaper to the bank and say, well, here's the ad we ran for $10,000. It didn't work, but you can have the ad. Really not much they can do with that. But you can take a car back. You can take a building back. And they can do something with that. So again, banks typically like collateral. While investors recognize you need marketing, you need R&D, you need other unrecoverable, non-collateral based costs as a firm, and they'll fund some of those efforts. Stage matters too, as far as how big you are. Are you just getting started? Do you have a couple of dozen employees? Do you have a few hundred employees? And what do you need money for then? And how you would repay that is certainly central to answer too. In general, this is kind of a stair step of where the ranges of capital tend to lie. when you're in this couple of $100,000, oftentimes it's owners, it's friends, it's family, it's friends of friends, and it's a few $1,000s here and a few $1,000s there that you're able to pull together. It's really once you get into needing some millions that venture capitalists begin to be interested. Maybe you get some that dip down a little bit lower.
What are angels?
Angels fill that gap, and we'll talk about what angels are. And you are a pretty big firm, by the way, that going public is even an option. You're probably upwards of maybe 25 or 100 million in revenue a year before going public is something that would be an option. So what it's used for, again, banks like assets, hard assets, reusable, reclaimable, collateral-based assets, typically. Investors will fund the riskier, the non-collateral, the R&Ds, the marketings, the salaries. Banks make interest on their loan, 6, 8, 10% interest. Investors get a share of your company. They may make the equivalent of 1,000% interest, 10,000% interest, based on how successful you are. Stage matters. You might, particularly as students or as early stage entrepreneurs, be able to secure money from competitions and grants if you are small. And then you stair-step your way through this, as we saw in the previous chart. Debt versus equity is something to be familiar with. Debt is fundamentally loans. I'm going to loan you money and you're going to pay me interest. Equity is I'm going to invest in your company. So in, I think it was last spring, so about a year and a half ago, we took a team of students out to Silicon Valley and met with a number of venture capital firms. One of them was called Greylock. They had put in, it may have been 25 million into Facebook. And that week, when Facebook went public, they made, I think it was 1.2 billion. So if we buy a stock and it goes up 10 or 20%, that's a pretty good return. If we make a $25 million investment and we get a $1.2 billion return, and even millions and billions, you know, they're all big numbers, but we're talking thousands of percent, tens of thousands of percent return. What happens if Facebook didn't make it? Their 25 million goes to zero. So it's high risk, high reward scenarios that equity investors are making. And that's why equity is typically the last thing you want to sell. You only have 100% of your company to work with. When you start selling off a little bit here and a little bit there, it diminishes the rest of what you have.
What does Mark Zuckerberg on Facebook?
Founders of big companies that we know, they might be in single-digit percentages. I'm not sure what his percentage is now, but Michael Dell owns about 16% of Dell, which still makes him a billionaire a few times over. So even you can own a minority of your company and still be exceedingly wealthy. And you always are thinking about, do I want to own all of a small pie, or do I want to grow my pie much larger, own a piece of it, but my piece of the big pie might in the end be bigger than owning all of that small pie?
According to who owns Facebook.com, Zuckerberg still has 28.2%.
So Zuckerberg owns 28% of Facebook.
Went up a lot today.
And they had a good earnings call yesterday, so their stock went up quite a bit.
34.
So again, you can own a sliver, but still do very well. For pros and cons, when you think of this, with debt, it's nice in that you own all the company. If a bank gives you a loan, you still own 100% of the company. The challenge is that you owe them their payment with interest, typically next month, no matter the health of your company. So in exchange for retaining ownership, you make a commitment to pay them, whether your company is successful or not, an agreed upon interest rate, typically in the very near term. If you're an investor, you may invest money in a company. It might be 5 years before you see any return. You might never see a return. Disadvantages, again, as I mentioned, is you owe them no matter what. So you're borrowing money, and then in essence, you're paying them back the money that you just borrowed from them a month later with interest. Now, you might have a year or multiple years to pay it back, so you're not giving all of it back next month, but you begin having to start making those debt payments back pretty quickly. There are organizations like the SBA in the U.S. that's a resource for facilitating loans and microloans, and they work with entrepreneurs all the way down into an average of $13,000. So in that way, you can get small amounts of capital on a loan basis if you work with some of these SBA programs. And SBA may back up or co-sign or essentially step in as the collateral guarantee for those loans. So that's a resource. And again, other countries and other regions may have similar things. Why would the government do that? Why is the government going to facilitate startups getting loans to start companies?
Because small businesses make up the bulk of our economy.
So they want the economic development. They want job creation. They want to create a tax base. So they're incentivized to do some of this as well. Equity is different. Equity is, we are going to get married. I am going to buy a share of your company, and once I own it forever. Or until we agree collectively that I'm going to sell it. In that sense, it might be individual investors, it might be big companies, it might be friends and family, it might be the co-founders of the company, it might be your future employees that are all owning a piece of the company as equity holders. We see equity taking a lot of different shapes and people raising money a lot of different ways. So with these crowd-based platforms, these are not equity, but the Indiegogos and the Kickstarters are funding in kind of a different way. It's not debt. They're not giving you loans. It's not equity, and that you're not selling them parts of your company, but people are going online and selling these mosquito fighting fabrics and kites that are selling USB chargers, phones of all types, and raising some pretty significant capital along the way from thousands of funders, often in a pre-sales type market. They're buying the product, waiting a few months for you to deliver as the entrepreneur. So we see, again, this crowdfunding model emerging as well. This is one that we've talked about previously. To my knowledge, one of the biggest, if not the biggest, campaigns in terms of how much money they raised. And these are, I think, available in Best Buy now. You can buy your Pebble watch at Best Buy. But they raised $10 million from 69,000 people in a pre-sales model. You see this happening, and this is a firm based in the Washington, D.C. area, of Fundrise. They are real estate developers that work to collaborate and identify properties, typically abandoned properties, typically properties that aren't being used, and/or land that they want to build something on, or buildings that they want to renovate. But what they try and do is identify these properties, feature these properties, and then market to the local residents as investors in that property. Historically, to be an investor in real estate, you're putting in hundreds of thousands of dollars per person. They are trying to democratize that a bit, where people are putting in hundreds or thousands of dollars per person. Why would I do that as a resident in the area? Why would I invest or lend money to a real estate developer to build something in my neighborhood?
It could appreciate the value of your home.
If I open or help contribute to the opening of popular retail, popular restaurant, popular real estate endeavors in my community, it might make my location more desirable. It might make my home value more desirable and higher. What else might it do? What else can it accomplish by me investing in things that aren't yet built?
Well, once it is built and they sell it, you can make whatever.
I can make some money, but I also might want a new restaurant. I also might want a new grocery store. I might want what it is that they are purporting to build. And you get to invest and try and facilitate the creation of such a thing. So again, interesting crowdfunding model in real estate. And we see crowdfunding, there's a lot of attention on Kickstarter and Indiegogo, but they are one of 138 crowdfunding platforms, crowdfunding websites in the US. And we see in lots of other regions, probably 100 in Europe, but we see in lots of other regions that there are 3 here, 2 there, 1 here, 1 there. So they're emerging pretty rapidly in a global marketplace. And when you look at just in 2012, there were $2.7 billion worth of transactions or funds raised by entrepreneurs reaching out to individuals at $25 or $100 or $1,000 each. And the pace of it went from 0.9, 1.5, 2.6. So we see pretty rapid growth there as well. The last thing I wanted to mention in this genre was this element of accelerators. And we actually have a student team from our Human CEOs program that's out in Silicon Valley now in this accelerator called Plug and Play, where they spend a few months in a temporary office in Silicon Valley where they have received some funding. I think it might be $20,000 perhaps, but you get a few $1,000s. You get access to office space and mentorship and other services. But the orientation is that they are going to work with hundreds of startups and lots of investors and do some matchmaking as well, where it's space, it's money, it's mentoring and advising, it's some matchmaking to put you in front of investors. And what you see here is one of their demo days where you have an entrepreneur that's presenting his pitch, and the bulk of the people out here in the audience are investors that are looking to invest in startups. So kind of another model of funding that comes with some level of social capital and some level of mentoring and advisement. What's in it for these guys? Why are they going to give money and spend time working with startups?
They get a percentage.
Because it's equity. So they, in exchange for this funding, are getting some percentage of ownership of the companies that are within their accelerator. So again, another model that's emerging. So in summary, when we think about sources of capital, as we've discussed, there are a variety of sources. The right type of money very much depends upon the timing, the purpose, and what stage your venture is in. There are also many new funding models that are coming to bear. And so with that, we've talked about crowdfunding, and this is something that's gained a lot of momentum in the US and Canada and Europe, and I expect other areas as well. And so in that context, begin to think about what are the sources that you need, what's the timing that makes sense, and that will give you some insight into what is the right pursuit of what capital at what time for your venture.